Hey there, welcome to Wealth Addicts. On today's video, we're going to talk about the topic of the difference between whole life insurance and index universal life insurance, what some of the differences are, and which one is right for you. So I've got Jason Francios with me here today. He actually called me today to talk about this specific topic and said, let's make a video out of it. So here we are. Jason?
Yeah, I've spent the last maybe 3-4 weeks really digging into this because I didn't really understand the differences beforehand. And you've explained it multiple times, but the level of understanding that you have takes a while for someone to really grasp. So I kind of wanted to go through the fundamentals. So the way I see it, the primary difference between universal life and whole life insurance is essentially how they invest the money that you put into the policy. At its core, index universal life uses options that are paid for from low risk securities to make money in the policy, whereas whole life uses mostly dividends from the profit of the business of selling insurance and the premiums itself. The most important thing that I learned between the two and what makes it beneficial for one person or the other is how quickly you have access to the capital that you put into the policy. So the whole point is someone would want to take on these policies is to use it essentially like a bank account, a high yield bank account at its core. That's really what it is.
What I look for in my clients is I want people to have enough understanding about what they're doing that if anyone were to ever question them and say, like, why are you doing what you're doing? You would not only know what you're doing, but you'd know the why. And so the fact that you jumped off of a phone call today with another insurance agent and decided that this was something you wanted to discuss with me and say, well, I was answering the questions they had and asking good questions. And they were coming back and saying, well, actually, Jason, you're right. You have made my day, and I'm super excited to keep going. So no, you're right on point with this. This is just a strategic way, both any kind of permanent life insurance that's structured to be overfunded where you can dump cash into it is structured to be able to let you store capital in something that is liquid and do better than a bank account. So think of this as a glorified way to store liquidity. And then the next step is how we access it. That's where we have some unique features as well, which I believe you're getting into. But that's the idea. It's a glorified way to store liquidity.
Yep, exactly. So it's basically a high yield bank account at its core with some additional protections that bank accounts don't have. Things, depending on the state you live in, you can have protection from bankruptcy, you can have protection from divorces, a lot of different things that bank account have. With that in mind, to me, the most important thing is being able to access as much of that money as possible to be able to invest it in assets that I believe are good investments, something like real estate. Single family homes personally is kind of what I'm looking at the moment. So and that's what was kind of the nail in the coffin as to why I think index universal life, when structured properly, is a much better option than whole life insurance, even when structured properly. With whole life insurance, from my understanding, almost all the cost of the policy, so that's the cost of insurance, that's the fees that you pay to the broker, everything else is front loaded on the front end. So your break-even point, even with the estimated projections of growth in the policy, based on how much you're putting in every year, doesn't actually hit break even as if you were to put the money in an actual bank account until typically year 6, 7, and some of them even out to year 10, depending on how it's structured. Because of that, I don't have access to that capital to invest elsewhere, which means I'm losing a lot of money in opportunity cost and due to the time value of money. With index universal life, when structured properly, I can typically see that break-even point sometimes in 12 months or less, depending on how much appreciation happened that year in the market. But typically it's looking around 2 up to 3 years max. So I can pull that funds out a lot sooner and invest them into assets, especially in today's market where things are down quite a bit. Or I might be getting ready to look at some potential foreclosures or some real estate deals where I need access to the capital now. It seems like there's a lot more risk if I don't have access to the capital.
Let's go through a couple things there, because one, I don't know that I would ever say that one strategy is wrong. I think that there's always a use and a place for almost any strategy in different fact patterns that go on. So your assessment that typically IULs have higher early liquidity is correct. And especially if you compare what 95% of people buy, or 99% of people when they buy an insurance policy will buy it under one set of rules. And so that means that when you're going to go to your normal insurance agent, they're going to tell you what they believe in, whether it's a whole life or IUL, and they're going to say you should do this. And so that's going to typically be a max funded policy, but without some of the other things that you do to reduce internal cost and grow your cash quicker. So that's why when you looked at your illustrations, they might have been breaking even year 8 or year 9 or year 10. That break even just means you have more cash in it than you've put into it. So the first question is why do you have more cash in the policy than you put into it? And that's because step one is you want to have enough cash that when you earn your return, be that a dividend or an interest credit or whatever function is giving you a return, you want that return to be enough to beat the cost of the policy. So if you think about this bucket of money, on one side there's cost, on the other side there's return. So the more full that bucket is, the less return you have to earn to be able to beat the cost that's going over there. So that's where whole life typically with its higher cost load and potentially lower returns is going to be a little bit slower on that. Especially with the way they're structured as a general rule of thumb, where agents have structured them where they're kind of maximizing on their compensation side, then you end up having a lot slower break even in place. And that's where you see those 8, 9, 10 break evens. We have whole life policies that we structure where I can get my break even down to like a year 5. I can get the expense ratio down to a lower number. So I do find some whole life policies to be attractive in certain markets, especially when we're in times when the market's very, very high and our likelihood of further appreciation is potentially lower. There's years when whole life might look more attractive than IUL year over year. But as a whole, your assessment, IUL is typically a skinnier chassis from a cost standpoint when it's structured right, and it's more liquid in the early years. And so that opportunity cost, even on the best whole life, I'm still usually only 80% liquid year one, in a perfect world. And that's with all factors being perfect. Most of the time, normally our liquidity is going to be closer to, if we want to have good IRRs, it's going to be closer to like 65 to 75% in year one, which is still attractive. With IUL, we might be 80 to 90, 92% liquid in year one. So that means if we put in 100,000, we can pull back out 90. So that difference in the amount tied up, if it's $10,000 to have an IUL on the same $100,000 policy, but it's 25 to have it on a whole life, that means we've got 2.5 times the opportunity cost that we have to earn to be able to beat strategy 2 versus what strategy 1. Does that make sense?
Absolutely. So just to kind of distill that down, because you don't have access to the capital earlier with whole life, you got to make a lot more money with that money you do have access to be able to make the same returns as having access to more capital in an index universal life outside of the policies when you borrow against it.
Correct. All factors being equal, that's the case of what would happen there.
So, I mean, just to kind of bring this back down to layman terms.
Yeah.
In a fundamental overview of what you're doing with this policy, it's using it as a bank account. Mm-hmm. And to do that, there's 2 important things. 1 is access to the capital. Mm-hmm. And 2 is being able to borrow against the capital at a positive rate, or at a bare minimum at 0. Because if you were to pull the money out of a bank account and you invest it, that would be borrowing at 0. So if you can meet those 2 requirements, you're at least equal to putting money into a bank account. Now, if you can make money on it, then you're starting to beat it plus protections and everything else.
And that's really, I think, the key crux of the argument of whether you should or you should use life insurance in your balance sheet, and where a lot of people get lost is you hear these terms of things like, banking to infinity or personal banking, those kind of things. There's all these different ways that people say the idea that you can do this repeatable fashion to have infinite velocity of money going forward. And that is theoretically possible. But to do that, what you have to have is you have to have your cost of the policy plus your cost of borrowing has to be less than the growth of the policy. So the mechanism for how this policy grows is going to be based on the type of policy you choose. And so, with a whole life, it's going to be based on a dividend where, you get part of that return is driven by the interest rate environment, the underlying interest rate environment. Part of that is going to be based on the company's profitability. But basically what you're doing is you're taking a risk, having an insurance policy as opposed to just having treasury yields. And that risk is returning a greater return. Now your borrowing is going to be based on normally like LIBOR plus a spread. So that's going to fluctuate with the interest rate environment as well. So you'll see these things here. There's a little bit of a spread over the borrowing rate typically because of company profitability. But if that spread is not large enough to cover the cost in the policy, then we're not going to bank to infinity. We're going to have a finite number there because it's going to slowly cannibalize itself because the cost is greater than our spread. So
Sam, do you want to briefly talk to exactly what you're talking about, but talk to the difference between whole and index?
Exactly. And that's the point I agree that's the next logical progression is you say, okay, well, if I'm over here and my cost to borrow is fixed, that's going to be the same whether I'm borrowing from a whole life or an index policy. Those are going to be almost identical. So that's a fixed cost. The next piece is what is our expense? Because the lower we can make that expense, the greater our likelihood of success will be. Because we know that this borrowing cost is the interest rate environment. And there's correlating factors to how whole life and index life policies perform when interest rate environments raise and lower. Because as they lower, typically equity markets shrink. It's because equity markets have been depressed. As debt rates raise, typically equity markets are doing better. Same thing for whole life, the same idea with growth there. So there should be a spread on both policies above the cost to borrow. The question is that spread enough to beat the cost? And so with the IUL, we can shrink those costs down quite a bit, for one, which is why we have the earlier liquidity of those things. So we can have a lower long-term overall cost. The best way to compare that is compare two IRRs side by side. The IRR of a IUL policy versus the IRR of a whole life policy with identical illustration rates will typically
And the
be
IRR
higher.
is internal rate of return.
Internal rate of return. It's what rate you earned year over year over year over year, net of all expenses. And so that factors in all the factors of what you put money into the bucket. Some of the money doesn't go back to you. It goes somewhere else in expenses. You show both buckets, putting the money in, you show the expenses coming out, you show after 20 years, what average, or internal rate of return did I earn over that time frame. That's the key that you look at there with that. So,
Cool.
So compound annual growth rate basically is what we're looking at there. The difference with the IUL, it was a real quick here, my bad. The difference with the IUL is that you have the returns on the index policy are based on the stock market. So it's tied to a particular stock indice. And that's going to be like the S&P, Euro stocks, a blend of some of the few, or the Dow or whatever. So it's going to tie to that where we get a return that captures some of the upside of the market. The insurance company is using on their side is they're using a sophisticated strategy to take, like you said, low risk equities to be able to go buy bonds that are going to have a yield to them that makes sure they can meet their 0% floors so you don't lose money. Then they're taking that risk premium, those additional dollars, to go purchase upside on the market. And so they're just doing an algorithm there to say we're going to buy the upside if the market goes down. We let the options expire worthless. If the market goes up, we capture upside up to a certain point. And they have their algorithm for how they calculate what caps they can provide based on the price of options and based on the amount of budget they have to buy options with. So what they've shown.
So the next question.
Go ahead. Yeah.
The next question becomes, when would whole life be beneficial for somebody as opposed to index life?
Good question. So with that, whole life, the benefit to whole life is that the returns are more steady across the board. So that typically dividend rates have a lot less fluctuation. And so as markets go up and down, that's going to be more, think of it more like a debt portfolio, and that it's going to be a lot more level across the board. We've seen most of these carriers have paid dividends for the last 150, 160 years. So very solid, secure type investments that work there. So if somebody is not necessarily going to be doing a significant amount of leverage, then I think that makes sense. If we're looking at certain death benefit plays where that makes a lot of sense. I even see some of my clients will do mixtures where we have like a 35% whole life or a 40% whole life, 60% IUL mixture. And that way we have, when the market's down, we have 40% of the whole life still providing some returns. The index policies are returning some. So there's every fact pattern for each person is kind of unique of what makes sense of like why we would analyze and look at we would look at. Good.
I guess the way that I see it, and I guess a much simpler sense, is I look at whole life almost like I would look at an annuity, where if I wanted cash flow later on in life, I want to pay more up front. And if I don't plan to leverage the money, it's probably a good idea because I know every year I'm going to get a good return. If I want to pull dividends out, 30, 40, 50 years from now. Where with index life, there might be some years where I can't pull anything out because I'm making zero. So if I wanted to just have a policy and not leverage it, so I don't care about having access to that capital in the short term, and in the long term, I want guaranteed income, it might be a better choice to go whole versus index. Any thoughts on that?
Well, I think that there's some strength and argument to that as well. I think that the answer is yes and no, because in theory, like the equity markets long term should outperform, and carriers are typically incentivized to maintain as high of caps as possible. And so I would think that long term that would still even outperform even with that. But in answer to your question, then yeah, that would be the thing. If you're looking for more security, more predictability, the whole life is going to be more predictable over time because it is a dividend rate that's going to fluctuate as interest rates lower. Dividend rates have fallen. As interest rates rise, they will rise again, and that'll just kind of level out throughout time there. But yes, that's a fair way to look at it, as it is a safer route. I will say a lot of times when people look at whole life, one of the tough things is that we're not really comparing apples to apples. And it's like the statement you just made is true for 98% of whole life policies. So there are a small subsector in which, when they are structured properly, whole life policies can be attractive, but it's a much smaller, it's a very small demographic of those that are structured that way, because the majority of them are structured like you described, where there's a slow break even. We're not breaking even till 8, 9, 10, 11 years down the road. The majority of the capital isn't accessible till you want to take like retirement type income. And if you do access it sooner, you're not likely going to make more money on the policy than it costs you to borrow and pay for the cost of your policy. So realize that there's always an exception, but yes.
Awesome. So, I mean, if you were to distill it, if I'm someone who's just watching this video, and I go to an agent and they write up either a whole or an index, either one doesn't matter, what would be the document that I would want to definitely look at to make sure, or to understand if they're structuring it well for me?
Oh, perfect. I was wondering to get to this question, because I know part of the goal here is you said you wanted this to be something that was easy to digest for the average person. And yes. I apologize in advance that I know we have not done that great up to this point, but this is, if you've tuned it out up to this point, pay attention to this, because this is the simplest way if you're ever doing these comparisons. So here are the things you would look for on an insurance policy. And this is true. This is product agnostic. This is strategy agnostic. This is agent agnostic. It's just for you to say, here's how I go and look at this. If you're trying to compare two assets together, be it whole life and index life or anything else, the best way to do that is to compare a internal rate of return report. So you would ask both carriers or any carrier you're looking at for an IRR report. What you need to know to be able to analyze this is, number one, you need to know how much capital went into it. What was the gross rate of return that we said? So say it's 6%. We have a gross rate of return. And then we want to see what was our net rate of return, which is the IRR, that compound annual growth rate of what amount of money do we have. We said we want to surrender this policy and pull our cash out of it at year 10, year 15, year 20, year 30. How much cash would we have there? Because then you have a starting point, an ending point, and an amount of time. We can figure a compound annual growth rate and say, if our gross rate was 6% and our net IRR was 5.5%, we know we lost 0.5 along the way there to this. And that's our expense ratio, is the amount that we didn't have from 6 to 5.5. You can get that for both a whole life and an index life policy and make that comparison. That's going to help you understand what the expense is inside the policy. So number one, what we want to look at, number one, is we want to look and see, when do we break even on the policy? So when we have our numbers that we have years 1 through 20, we want to say, when do we have more capital in the policy than we put into it? Because you can't fund these all at one time. You have to fund them over time, because the way IRS rules work. So if we're going to fund it for 7, 10, 5 years, whatever's the number, when do we break even? I want that break even to be no later than year 5. If it's later than year 5, then it illustrated later than year 5. In reality, it may be sooner, maybe later, depending on the credits or dividends of the company. But I want us to illustrate based on current assumptions to at least have a break even that is likely to break even before year 5. If it's later than year 5, you need to question what you're doing. And that's just true categorically across the board. If you have health concerns, if you have a different age, that normally doesn't weigh in too terribly much, but if it does, I might go as far as year 6 if there's some unique factors in place there. But definitely year 5 is the cutoff. If it's later than that, you need to go do double research and make sure you're doing what you should be doing. That's piece number one, is when do we break even? Piece number 2 is, what is our 20-year IRR? Because it's very likely you'll keep these policies for some point in time. That gives you time to get past the front-loaded charges and have things level out. Don't just look at year 1, because these things are front-loaded. They'll have a little bit of a J curve where you put in 100,000, you can only loan back out 90 because there's some cost in the early years. That's all natural. So that's going to take time for that J curve to even out. But if you look at a 20-year span, that's going to give you a really good picture of what the costs are in these policies, and compare IRR to IRR. That's going to give you a really good look at that. You can say, okay, well, here's what the actual cost is in that policy. I want to make sure that cost is ideally less than like no more than 75 basis points on the top side. If we are giving up more than 75 basis points of expense, then I think we are having an issue there. And the idea behind that is,
so the way to calculate the cost would be how much money you've put in over the cost of the policy, and that should not be more than 0.75.
Oh, good point. The way to calculate that cost is, you say, if my gross return is 6 and my net return is 5.5, my per year average cost was 45 or 50 basis points. And that is going to be, if you say, if my gross return is 6%, and or if my gross return is 5% for easy math, then my expense ratio there's a 10% expense ratio, and those are in the numbers of what I'm comfortable with. I want to have less than a 15% expense ratio on the high side. It really should be less than a 10% expense ratio if we're structuring these right over a 20-year time frame. And so that's what we're looking at, is in those lights, to see like, can we get to those numbers where we have a sub 15% expense ratio on that piece there. If we get
Just
there,
recap that. Rule number one, shouldn't have a break even past 5 years.
correct.
Rule number two is the difference between the estimated rate of return, so that 6% or whatever they, well, just real quick, can that number be adjusted by them, or is that
It can be adjusted by the agent, absolutely. So the agent can adjust that number up and down.
Make sure they're putting realistic numbers in there.
And they are limited. Most insurance agents are limited. Like, there's a lot of guidelines with how and what you can show prospectus wise. Honestly, from calculating expenses, the number's somewhat irrelevant. It's more the order of returns that matter. But as far as on that, the answer is you can have them put in. The numbers need to be realistic, but they're kind of capped with how high those numbers can be anyway. Okay. You should also make sure they put in realistic low numbers too, because like you wouldn't want to say most of these carriers have paid dividends for 140, 50 years. They have these index policies are unlikely to have 5 years of straight market downturn because of the way that they reset each year. So the market goes down, we reset and can capture the upside like we did last March. Those things are all things that you would trying to put in realistic is a fair statement. You want to make sure it's real on both sides.
But so the difference between that and the actual return should not be more than 0.5%, is what you're saying. If you start seeing more than 0.75, there's a big problem.
Yes, and that's kind of that. And that would vary based on the amount of return, but for today's interest rate environment, that's about where the numbers should look. And the factor there is it's a percentage of your total return. Or if we say say your total return was 20% was your gross return, for example, we would want to have no more than 3% or so in that loss, because we want to have like no more than a 15% expense ratio is what we target, is to have an expense ratio that's in that range. Does that make sense? Cool. So basically, if you say if the gross return is 10, we want to have no more than 1.5% lost, or we have at least an 8.5% net along the way there.
Awesome. And then any other general rules of thumb before we wrap this video up? Before
you recap, 3 things. I only gave you 2, and I got distracted there. Number 1 is the break even. Number 2 is the IRR differential, the spread, the cost. Number 3 is going to be the year 1 liquidity. So when we put in year 1, if we return 0% that year, or whatever is the guarantee for that year, what is the amount of capital we have available to borrow in year 1? So that tells you the opportunity cost. So year 1 liquidity, year we break even, and long-term IRR are the 3 factors that you review. If you review that, you're going to be ahead of 99% of people who buy and sell insurance policies.
Awesome. Thank you very much, Sam. So just to recap really quickly, when you put the 2 types of policies side by side, the main difference is how they're invested and how the cost structures are set up. So looking at the 3 most important things that Sam talks about, which is when do we break even? What is the cost differential at year 20? And what is our 1-year liquidity? We find that many times Universal Index Life will be the better option because of the way that they're structured and how they invest the money. With whole life, there is some advantages as well. You have a little bit less risk, especially if you have some years that are not going to perform very well in the markets. At least you still have some appreciation happening in those years. But you are going to take that hit on the front end with the liquidity, and depending on how it's structured, which I think no matter what you choose is the most important thing, is understanding how it's structured, making sure that it's structured to be the most efficiently utilized as possible. If you have any questions about this, please feel free to leave comments in the section below and subscribe to the channel. We have a lot more videos coming out soon dealing with multiple different types of investment strategies, including more videos specifically on Universal Index Life and whole life insurance to be used as a banking source. Thank you very much.